Imagine walking through a growing industrial city. Hundreds of factories are operating. Trucks are moving in and out. Construction projects are underway everywhere. Most businesses look similar from the outside, and most people pay little attention to them. Among them stands a company called Fabtech. For years, it quietly built its capabilities. It wasn't the biggest name in the market. It wasn't the stock everyone talked about at social gatherings. It didn't have the excitement of a trendy technology company. But a few experienced investors noticed something. They saw business steadily expanding into new countries, winning larger projects, improving execution, and building relationships across the pharmaceutical and engineering ecosystem. While the broader market remained uninterested, these investors slowly began building positions. This phase is called accumulation. Accumulation occurs when informed investors gradually buy shares over time without creating a dramatic rise in price. Think of a farmer quietly buying neighboring farmland before everyone discovers that a major highway is about to pass through the area. The market saw an ordinary company. The smart money saw future potential. As months passed, ownership gradually shifted from impatient traders to long-term investors. The stock stopped falling. It stopped attracting attention. It simply moved sideways. To most people, nothing appeared to be happening. But underneath the surface, the foundation was being built. This is known as base formation. A base is a period where supply and demand reach equilibrium before a larger move begins. Imagine a rocket sitting on a launch pad. From the outside it appears stationary, but engineers are completing the final checks before ignition. Then the business began delivering proof. Revenue started growing consistently. Profits improved. International operations expanded. Customers from the Middle East, Africa, and other regions increasingly became part of the company's story. The company was no longer surviving. It was growing. This stage is called earnings momentum. Earnings momentum occurs when profits rise strongly enough to validate investor optimism. It is similar to a student long believed to be talented finally bringing home top exam scores. Potential is replaced by evidence. As results improved, the market slowly began to notice. Fabtech started outperforming many companies around it. Investors call this relative strength. Relative strength simply means a stock is performing better than most of its peers. Think of a marathon where one runner gradually separates from the pack while maintaining a steady pace. The company was no longer merely participating in the race. It was beginning to lead. But every growth story faces a test. After a strong advance, some investors took profits. The stock corrected. The excitement cooled. Many observers wondered whether the story was over. This is known as a pullback. A pullback is a temporary decline within a larger upward trend. Imagine a mountain climber stopping at a ledge to rest before attempting the next section of the ascent. The pause does not mean the journey has ended. It often prepares the climber for the next stage. What made Fabtech interesting was that despite the pullback, the business itself continued moving forward. Revenue growth remained strong. Profit growth remained positive. Promoters retained a significant stake. Debt remained low. International expansion continued. Large investors did not appear to be abandoning the story. This is known as institutional sponsorship. Institutional sponsorship refers to continued ownership and support from professional investors and funds. It is similar to experienced builders continuing to invest in a project even after construction has already begun because they believe the finished structure will be worth much more. Then came an important chapter. The company experienced a weak quarter that worried many investors. Margins became volatile. Profits temporarily disappeared. The market questioned whether growth was slowing. But the following quarter told a different story. Revenue surged. Profits rebounded sharply. Execution improved. Projects were completed. The company effectively told investors, the engine never stopped. We were simply moving through turbulence. This strengthened the belief that the underlying business remained healthy. Yet despite all these positives, one challenge remains. The challenge is not revenue. It is not earnings. It is not expansion. It is cash. The company is growing rapidly, but customers often take a long time to pay. Receivables have risen significantly. Profits are being reported faster than cash is being collected. This creates what investors call working capital stress. Working capital stress occurs when growth consumes cash because money becomes locked in receivables and project execution. Imagine a bakery selling 1,000 cakes every day, but allowing customers to pay 6 months later. The bakery appears successful. The income statement looks strong, but the cash register tells a different story. This leads to the next important concept: cash conversion. Cash conversion measures how effectively reported profits become actual cash in the bank. A business owner may show impressive profits in a notebook, but true financial strength is demonstrated when those profits arrive as cash deposits. Today, this is the question institutions are asking. They already know Fabtech can grow. They already know Fabtech can win projects. They already know Fabtech can expand internationally. What they want to know now is whether Fabtech can convert growth into sustainable cash generation. The next chapter of the story will likely be written by 3 numbers: receivables, operating cash flow, margin stability. If receivables begin stabilizing, operating cash flow turns consistently positive, and margins remain healthy, the market may begin viewing Fabtech very differently. The company could move from being an emerging growth story to becoming a genuine institutional favorite. In many ways, Fabtech resembles a young athlete. First, coaches quietly discover the talent. Then training begins. Performance improves. Competitions are won. Sponsors arrive. The athlete takes a brief rest. And then comes the most important phase, the transition from promise to greatness. That is where Fabtech appears to stand today. Not at the beginning of its journey, not at the end, but at the point where it must prove that rapid growth can become durable, cash-generating, long-term value creation. The market has already seen the talent. The next test is whether the company can transform that talent into sustained excellence.
Don't forget to like and subscribe. Don't forget to like and subscribe.